All right, good morning and welcome to First Bank's COVID-19 Updates for Businesses webinar. I'm Mike Vanderveld and I'll be your facilitator. This will be the first in a series of COVID-related webinars we'll produce. We're working on topics now that include how to improve your sales, tax planning, valuations, fraud prevention, and more. Keep a lookout for First Bank emails, and as always, be sure to check our COVID website on firstbanks.com. Before we get started, allow me to cover a few logistics. If you just joined the audio, please be sure to join the webinar as well so you can see the slides. We'll have about 30 minutes of content and then 15 minutes of Q&A. Your lines are muted, but at any time, please send us your questions through the webinar tool. Let's meet our presenters. Susan Jones serves as the tax director for BKD's St. Louis and Southern Illinois practice unit. Jacob Hirschend is a risk management consultant for MMA based in St. Louis. And Tim Fogarty leads the First Bank's Midwest commercial banking team. You'll find their complete bios in the handout section of the webinar tool. Mr. Fogarty will start us off today with some updates on the Payment Protection Program. Next, Mrs. Jones will cover some tax strategies as they relate to the PPP, and then Mr. Hirschend will touch on risk management and insurance-related issues. And now, please bear with me as I read through the legal disclaimer. This presentation is furnished for informational use only. It is not intended to be comprehensive, nor does it constitute legal, accounting, tax, or other professional advice. We encourage you to consult with your legal, tax, and/or accounting professional for specific advice. This presentation is based on information available as of the first date and time of delivery of this presentation. Due to the evolving nature of the regulations and agency guidance addressing the Payment Protection Program, all information in this presentation is subject to change without notice. First Bank recommends a thorough review of the CARES Act and SBA interim final rules. These documents can be found at firstbanks.com. All right, we are ready to dive in. I'm going to pass it over to Mr. Tim Fogarty.
All right, thank you, Mike. And thank you all for calling in today. And thank you for your business. As a fourth generation family-owned bank with a focus on serving family-owned and privately held business, we understand and share your concern as a result of the COVID-19 pandemic, particularly as it relates to your business, your families, the safety and wellness of your employees and your customers. This is the third webinar we've held focusing on COVID-19 and the Payment Protection Program. The first two are available on our website, but as Mike mentioned, there's been a number of changes. So we encourage you to listen to those as well, but there's been a number of changes to the program that you need to be aware of. This event, this pandemic has really been a catalyst for us to reach out to our clients and to enhance our communication. It's a strategy of ours for 2020 to be in a position to provide meaningful information to our clients. Today, we are expanding on our prior webinars by including two experts in accounting and insurance to share relevant information on COVID-19 as it impacts accounting, tax, and risk management. And as Mike mentioned, we're going to continue our series here coverage of the PPP program, but adding other relevant topics, including an economic update from David Presson, Director of Investment Services, First Bank Wealth Management, David Fredericks on estate planning in this environment, cybersecurity, selling techniques in a remote environment, and we'll be having a leadership topic led by Mike Schilt, manager of St. Louis Cardinals. We'll be talking about leadership in this environment, but leadership in general, and hopefully a little bit about baseball. So look forward to those announcements. You got the first slide up. This is really a little bit of background. The president signed the CARES Act in March. Shortly thereafter, the program started, $350 billion in funding. The money ran out in 14 days on August the 16th, and then there was an additional allocation of funding that occurred thereafter, and that's the funding round that we're in right now. It was originally $310 billion. There's been 8 amendments to the interim final rules, and as you can tell by our website and other resources, there have been numerous updates from the SBA on guidance. Go ahead to the next slide, Mike. Okay, just a little background on what's happened in the first and second rounds for your interest. In the first round, as you can see, the $342 billion was allocated and funded 1.6 million applications, and that funding ran from the 3rd of April to the 16th of April. Then the second round started April 27th, where and this is data through May the 8th. It's still ongoing, but there's been a number of changes. You can see, obviously, the average loan in the first round was $206,000. The average in the second round to date is $73,000, and significantly more applications under $150,000. Now, in the first round, self-employed individuals and sole proprietorships were not allowed to start applying until after the first week. That left only 7 weeks in funding, and maybe some of the larger businesses were better prepared to provide the information. So that's kind of evened out. But I think a particular note is in the last 3 days of that, so May the 5th to May the 8th, the rate of applications has significantly slowed. In the second round, they were averaging over 200,000 applications a day and 73,000 per loan. In the last 3 days, May 5th to May the 8th, that slowed to 64,000 per day and only 40,000. So could be a number of issues that announcements that have been made in the last week by the government, by the Treasury Department, by the IRS, that have impacted the coolness towards this program last few days. Clearly last week, and Susan's going to touch on this a little bit, the IRS indicated that while the CARES Act specifically said the debt forgiveness portion would not be a taxable event, they ruled that the expenses related to the forgiveness was a taxable event. So that's going to have an impact. That really is, as a result, it's making it a taxable event. And Susan will go into that a little bit. I think there's some more current information on that, and I think that's being addressed right now in Congress. The other one of the reasons for the slowdown, there obviously was the safe harbor on the need clarification that we'll talk about, but there's a number of businesses also that the impact because of the shelter in place and stay-at-home orders in various states and not being able to open for essential businesses, bringing employees back just wasn't feasible for them to sit around and do nothing. And particularly if it was going to be a taxable event, it would turn out to be a negative on those clients. So I think that really, all those factors really have slowed that the application process. Because at the current rate, in that the last 3 days, the rate of allocation was like $2.5 billion. So at that pace, the program would really have another 40 to 50 days to run at that pace. So I think there's some changes being contemplated right now and discussions that will change some of that, and we'll get into that a little bit later in the presentation. Last week, you can move forward, Mike. And this week, rather, there was a report from the Inspector General of the Small Business Administration, which is really the auditor, on the Payment Protection Program. And I think there was the following areas were not fully aligned with the provisions of the Act, per the Inspector General. 1, prioritizing underserved markets. 2, loan proceed eligibility for forgiveness, the guidelines for deferment, and then the registration of loans is more of a technical factor. You can push on to the next page, Mike. Okay, in terms of prioritizing the underserved and rural market, the SBA indicated they did not require demographic information to identify PPP borrowers in these markets. I think the correction action to be taken is they're going to amend the application for those that are applying now that will include demographic information, and in the forgiveness portion of it, there'll be information that's going to be optional to collect on demographic information at the loan forgiveness portion of the program. You can go to the next page. And I think this kind of covers the relevance and the whole area around the forgiveness and the lack of clarity around some of the rules on forgiveness. The SBA found that the Inspector General found that the rules didn't necessarily align with the CARES Act in terms of the forgiveness portion of it. So the maximum loan amount was 2.5 times the monthly payroll, but the forgiveness amount is only covered an 8-week period of time. So there's a mismatch for a program that was intended for primarily to be used for payroll, for maintaining pay protection. They also indicate the allowable uses, which we'll get into in a little bit. The other uses that you can grant forgiveness on up to 25% may not, in many cases, be enough for 100% loan forgiveness, and they're asking for additional clarity on that. And then also and they're asking the SBA to evaluate the negative impact on borrowers regarding the eligibility of forgiveness and update on these requirements as deemed necessary. The SBA was, per the CARES Act, was supposed to provide guidance on this within 30 days. And it was noted that they had not done yet. So I really believe there's more information coming on this forgiveness portion of it. We can go on to the next page. Oh, yeah, loan deferments. Okay, so the other point of reference is the SBA did not clarify the rules around deferment as they were supposed to in the Act. So basically, where the Act was written, there was a number of changes from the Act to what the SBA guidelines were in terms of the deferment piece. They did say clearly that any principal and interest on these loans would be deferred for 6 months. They did not give clear indication at what the if there is any forgiveness balance after the forgiveness or residual amount, how is that to be handled? Our program, we designed it with payments to begin after the 6 months deferment period, after the loan forgiveness period, and amortizing that over 18 months. The Inspector General has asked the SBA to clarify its guidance on this issue and the issue of deferments for those beyond the 2-year program that are going to have trouble servicing the debt if there is a remaining balance. I think yesterday we saw Secretary Mnuchin announce he will be reviewing the guidelines and for greater flexibility in the forgiveness portion of it. I think they recognize that some of the rules were not fair to some businesses, particularly retail, restaurants that had orders to shelter-in-place orders in those communities. They were not allowed to open, and their use of that program was really curtailed by some of the rules of the program, that they could not really technically open up until after the shelter-in-place orders were eliminated. Also, Senator Marco Rubio announced yesterday, he was the chairman of the Senate Small Business Committee and one of the architects of the CARES Act, that they're working on plans for greater flexibility and confirming the guidance for the forgiveness. So I really expect, this report to be a catalyst for the Treasury Department and the SBA to clarify the rules around the forgiveness. You can go to the next page, please. I won't repeat these again. These are very clear. I do want to, I put this up, and Susan's going to talk about it a little bit, but the one thing I wanted to add is a lot of times when you see information regarding the eligible uses, they use the term mortgage interest. And I want to clarify that that interest on any debt obligation, if the debt is incurred before February 15th. So if the note or the obligation was in place before February 15th, any interest that is paid on any debt that the company has is eligible for the program and eligible for the 25% of the forgiveness amount. So that could include any lines of credit, term loans, real estate loans, floor plan loans, any debt obligation. Next page, please. We wanted to bring your attention to some fraud awareness that's kind of taken place in the program. There's been a lot of anxiety in the country over this program, over the borrowers' applications and the time that was delayed in getting applications processed. And there was just a real hunger for information on the program and where their application was at their particular financial institutions. So as a result of that, they were taking calls and offers for applications from various people that were really unknown to them through emails and calls. In some of these situations, callers were offering to take the application and asking for private payroll information on their employees. So on the next slide, I think we just need to be vigilant on the fraud awareness that's going on in this environment with a lot of people working at home and with this particular program. The SBA will not reach out to you directly regarding this application. They may in some point in the future regarding the forgiveness portion of it, but that's generally not how the government acts. They generally do things in writing. So be aware that they do not, they're not going to call you regarding your application. If you are contacted by somebody, if you've made a loan or anticipate applying for a loan, be aware of those offering to process your loan but charging a fee. The fee for the PP program is not paid by the borrowers, and if there is an offer that includes a fee paid by the borrower, you should suspect fraud. There's been a number of phishing attacks and scams utilizing the SBA logo. These are attempts to obtain personal identifiable information, obtain access to your banking, or to install ransomware and malware on your computer. And just be aware that if you're getting emails from the SBA, you need to check the sender's address as you do in regular course of business, and not be taken by using the SBA logo. The SBA does have a list. We are approved lender for the SBA. They have a list. It's on their website of all approved lenders, and there's 5,600 of them. But you can data check that it's an approved lender in the program through the SBA site. And of course, for our borrowers, I think I would for First Bank clients, Claire, just recommend talk to your banker, your relationship manager, your branch manager, your business banking representative if you have questions. Next page, please. As we talked about a little bit earlier, it was much publicized that there was a number of companies, public companies, large companies that took advantage of the program. They created some turmoil. So the Treasury Department indicated that any loans over $2 million, well, they clarified their rules on the need, which we'll get into the next page, but they indicated anything over $2 million would be subject to a review during the forgiveness portion, as well as any other loans as appropriate. So they're not limiting it to those over $2 million, but they're specifically indicating that they will review anything over $2 million. And then there's a safe harbor provision that if you return the money, if you've applied for the loan, it's been dispersed and return it, you'll be held harmless if it's applied before May the 14th. This is the safe harbor certification, eligibility certification that the SBA provided. Clearly, the economic uncertainty makes the loan necessary to support the ongoing operations of the applicant. Also is expanded regarding the second bullet point that taking into account the current business activity and their ability to access other sources of liquidity sufficient to support ongoing operations in a manner not significantly detrimental to the business. So if you have any questions on that, our advice to our clients has been to consult legal advisors on their application and make a determination based on that. Go ahead, Mike. I will say we have there's a lot of confusion, of course, on the forgiveness portion of it. One of them was defining full-time equivalents. So the American Institute of CPAs has provided some good clarity or a way to define that, which we've included in here. Also that information from the American Institute of CPAs is also included in our website under the resources section of COVID-19. It really is and I would recommend that you look at that. It goes into detail about documentation needed for the for the application process, as well as information that will be required for the forgiveness portion of the application. And so that's a really good resource to use. I will say the forgiveness period will begin, 8 weeks. The forgiveness period can start as soon as 8 weeks after the 8-week covered period, but it has to be applied for by June the 30th. I'll go to the next page, Mike, and I think that really clarifies this. Is just saying, the measurement used to determine the FTEs, it just be consistent in the measurements. It's a comparison of before and during the covered period. So really just be simple and consistent with how you define FTEs in both those cases for the comparison purposes. Next page, Mike. And finally, we've added some resources for people to further review. I found the U.S. Department of Treasury site to be very complete, as well as the SBA's, the Office of the Inspector General of the SBA, the American Institute of Certified Public Accountants, and then our website, COVID-19 website page. So I'll finish my comments there and hand it over to Susan. Thank you both to Susan and Jake for participating with us on this webinar. Susan?
Great, thank you, Tim. Well, I appreciate the introduction and the opportunity to be here today. There's obviously been a lot of talk, and I know, Tim, you and your team at First Bank have done a lot of work on this and helping your clients maneuver the very complicated rules. And, again, we are still waiting for so much really critical guidance that makes some of these conversations a little bit difficult. But let's skip forward. Yeah, and let's, actually go to one more. I think Tim, again, did a great you have a great background on the PPP loan, the eligibility, and some of the really integral pieces of that. So I just wanted to touch a little bit on some of the issues that we're seeing with forgiveness. I think, again, we're still waiting on that critical guidance that we had expected at the end of April, and here we are a couple weeks later with, unfortunately, not much more information. I think, the issue about the full-time employees, the 75%, 25% split, that was something that, again, I think most people who took the PPP loans expected, and although we do still need some guidance on that, that was something that was, I think, anticipated at the outset. But I think that the full-time equivalent issue and the potential for the forgiveness piece to be reduced, if the full-time equivalents are reduced, caught people a little bit more by surprise. And so I think, again, that guidance from the AICPA is good, and is what we're also advising clients to follow for now. And there also has been recent guidance. One of the other issues that came up was because so many states have now expanded the unemployment benefits, that some businesses are actually having trouble rehiring workers. And so we did see some taxpayer-friendly guidance provided that does say that if a small business makes a written offer to rehire a worker and that worker declines that offer, that employee won't be counted in looking at that full-time equivalent potential reduction. Let's move on to the next slide real quick. And one of the other things, really, unfortunately, not a taxpayer friendly ruling that Tim had alluded to earlier, was recent guidance that came out that discussed the implications of expenses that are paid with forgiven funds. So, included in the original CARES legislation, it very specifically says that loan proceeds that are forgiven are not includable in taxable income, which of course is a good result for taxpayers. Now, this more recent guidance, though, came back and said, well, that's still true, but by the same token, any expenses that are used, that are paid for with PPP funds that are ultimately forgiven are not tax deductible. And so, again, if we look at those costs, those allowable costs, payroll, interest on certain loans, rent, all of those expenses that would otherwise be deductible, the end result is an increase in taxable income by that same amount. So, whether it's an extra $1 million of income or an extra $1 million of non-deductible expenses, the ultimate net result is the same, and it's increased taxable income for the year. So, that is something that I think we'll maybe see some additional guidance on. That created a lot of controversy. Some of the top tax advisors, the White House, have come out pretty forcefully against that. And the Treasury has noted that they're currently reviewing that guidance. So again, hopefully more to come on that, but right now certainly not a good result. Let's move on to the next page. I also wanted to cover a few other provisions that were included in the CARES Act that are not directly related to the PPP loan program. So the first is the employee retention credit. And this credit is not allowable to businesses that have or are using the PPP loan program, but it's a payroll credit that is allowed on 50% of qualified wages that are paid between the period from March 12th through January 1st of this year. I'm sorry, December 31st of this year. And the credit is allowable on up to $5,000 per employee. So on wages paid of up to $10,000. And to qualify, an employer's business either has to be fully or partially suspended due to a government order related to COVID-19, or they have to show a significant decline in gross receipts, which is generally defined as a 50% reduction compared to the same period in the prior year. Let's move on to the next slide. And the way that the qualified wages are determined are based on how large the employer is. So for larger employers that have more than 100 employees, qualified wages are those paid to employees that are not providing services because operations were impacted. Whereas smaller employees, those with 100 or less, and I apologize, there is a typo on this page that says more than, but it's actually fewer, 100 or fewer employees. In that case, it's wages paid to any employee, regardless of whether the employee is providing services. Some good recent guidance from the Treasury does show that employers can treat health plan expenses for furloughed employees as qualified wages for purposes of this credit. And also those employers who decide to return their PPP funds by tomorrow are actually eligible then for the ERC. So again, some good news for those employers. So that is one thing that we've been working with clients as they think through whether they want to return their funds, is the impact of, especially if they had received funds and then in doing the calculations, it had been determined that the forgivable piece might be much less than originally anticipated, looking at the cost benefit between, again, keeping those potential PPP forgiven funds versus making the decision that the employee retention credit might be more beneficial. Let's move on to the next slide. One of the other provisions is a simple deferral of payroll taxes. And so this is not a permanent, tax savings, but just a deferral opportunity, but also can be, beneficial to employers. And this is for all employers, so not based on a size factor. And it's employers and self-employed individuals who have employees can defer the employer share of payroll taxes from the period of March 27th of this year through the end of this year. And then those deferred taxes are due in two installments, one half by the end of 2021 and the other half by the end of 2022. Again, this payroll deferral applies to all employers, so there is no specific requirement to show a COVID-related impact. However, it's not available to any employer that receives PPP loan forgiveness. And one of the, there had been some confusion at first whether an employer that was going for PPP loan forgiveness, but of course didn't know yet whether or not that would actually come to fruition. There was some concern whether they could actually use this this program in the interim. And so they did come out and provide some guidance that until the loan is actually forgiven, employers can take advantage of this deferral opportunity. And then it's only when that loan is actually forgiveness, when that paperwork is in hand, that forgiveness piece cuts off for wages paid after that date. But even those kind of pre-forgiveness deferral, those deferred taxes do still are able to be deferred for that same period. And so again, that was, I think, some much needed guidance in terms of the ability to use both of those programs at once. Let's move on to the next slide. That's great. There's also there were some very taxpayer-friendly income tax provisions included in the CARES Act that I wanted to mention briefly. The first is really just a technical correction to a drafting error in the tax reform legislation that was passed at the end of 2017. And that was this first circle here, the qualified improvement property. Again, because of the drafting error, there were certain business property that were treated as not eligible for bonus depreciation. And although it was widely understood that it was a simple error, and many requests were made for correction well before this CARES Act, it was included in the CARES Act. And so that can provide an opportunity for businesses to look at their depreciation schedules and possibly go back even to the end of 2017 and see if there are some additional deductions that could be included either on an amended return or on a current return just filed making an accounting method change. So that can be, again, a good opportunity for refunds. The second circle here is the business expense limitation that was enacted also as part of the tax reform legislation at the end of 2017. And so under that provision, there had been a general limitation on businesses that their interest expense could not exceed 30% of their adjusted taxable income. And that, of course, was, provided quite a blow to some businesses that were fairly leveraged. And under this, again, new current law that goes back to 2018, that limitation is now 50%, which again can provide not only current tax benefits, but also the ability to look back and see if there's an amendment opportunity in 2018. The next rule is the suspension of the excess business loss rules. So again, this was a new rule that was created beginning in 2018 because of the tax reform legislation. And what that said is that a taxpayer was not able to use more than $250,000 or $500,000 for a married filing joint company or couple of business losses against non-business taxable income. And any amount in excess of that was converted to a net operating loss and then had to be carried forward. And so that was created opportunity, or that created events where there were actually taxpayers that had significant business losses, but because of this rule, weren't able to take all of that against their current year income in 2018 and actually had to pay tax on their other income. So again, this is now completely suspended for several years, and there's the ability to, again, go back to 2018 and take a look and see if there's opportunities to sort of free up those losses and again generate refunds. And this also kind of goes together with this next and the last circle here is the ability to carry back net operating losses. And so again, I know I keep saying this, but as part of the tax reform legislation, one of the other changes was that net operating losses, rather than being able to be carried back or carried forward, because of the rate change, there was that ability to carry back was kind of taken off the table, and it could only be carried forward indefinitely. And so as part of, again, the CARES legislation, that ability to carry back is now, it's back, and it's actually expanded so that you can actually carry back a net operating loss for 5 years. And so again, for some of those losses that may now be freed up in 2018 because of the suspension of the business loss rules, taxpayers can actually go back all the way back to 2013 if they need to in order to offset income in that year or those years, going forward, in order again to free up additional cash that they can get right now. And the IRS came out with even a fax number that's for individual taxpayers who are able to use this provision and amend returns in order to carry back losses, can actually now fax in those forms, the 1045, and receive the refunds even more quickly. So I think that's, again, can be really helpful provision for a lot of taxpayers. Let's move on to the next slide. And then just a few individual income tax provisions. This first one is the recovery rebate, which, probably many people on this call today might not qualify for, although, probably many of you, maybe you don't, but you have children that might. And so it is $1,200 per individual, so $2,400 for a married couple, and also an additional $500 for certain dependents. It is, again, subject to a phase out for high earners. And, that's been a little bit of, I think, confusion and people waiting and not sure when they're going to get their check. There is the ability to go on the IRS website and check the status of the payment. So again, if anyone on this call has some kids that are anxiously waiting for that, they are able to go on the IRS website and find out the status. There were also some really taxpayer-friendly provisions related to retirement accounts. So the first is the waiver of the RMDs for 2020, and that is not only for the IRA owner, but also for inherited IRA. So if a beneficiary has an IRA, those RMDs are waived as well. For taxpayers that have already taken their RMD before this rule came out, from February on, most taxpayers are able to recontribute it by July 15th without an issue. If someone did take an RMD in January, right now the return of that money is limited to those who were directly impacted by COVID-19, but I think we are still hoping for some additional guidance that might expand that as well. There's also the ability to withdraw distributions from retirement accounts for up to $100,000 without the 10% early withdrawal penalty, and then the ability to pay tax on that over a 3-year period, or even return those funds within that period, which again can be very beneficial to taxpayers who might be having some cash flow issues because of current events. And then the last one I wanted to mention is just the suspension of the 60% adjusted gross income limitation on charitable deductions. So typically an individual can gift up to 60% of their adjusted gross income for cash gifts to public charities. And so as part of, again, this hope that kind of free up some cash for some of the nonprofits, that was raised to 100%. And so a taxpayer could theoretically give away 100% of their income in 2020 and not pay any tax based on that gift. Great, and that was really what I have today. Again, I know we'll have questions later, and I think, Jacob, I'm going to turn it over to you. And also, I just want to mention BKD. We have on our website some really good resources on both what I discussed today and then also some other aspects of COVID-19, as well as webinars, either that we've done, the archived, or a list of webinars that are coming up. So I'd encourage anyone who has more questions to look at that as well. And my contact information is here, so also feel free to reach out to me directly. And with that, Jake, I think I'll turn it over to you.
Susan, thank you very much. And also, Tim, thanks for including me and on this webinar today. Good afternoon, everybody. My name is Jacob Hershen. I'm with Marsh McLennan Agencies, formerly known as J.W. Terrell here in St. Louis. Go to the next slide. As we're getting back to work, returning to work, there are a couple of things that we just kind of need to start thinking about as far as the risk side of this conversations are going. The first one is really the NCCI has a new classification code for COVID-19 for its employees, specifically those that are working from home and also are possibly as a result of not working, but also working at home due to COVID-19. It's a classification code 0012. This has a $0 classification code against your work comp, so your work comp will then be adjusted accordingly. So depending on how that's set up, it's something that we could possibly talk about. The next one, I just had a conversation about an hour ago with a client, and we're talking about the need for an updated HR policy handbook and doing a review of that, especially concerning COVID-19 and all of the different pieces, specifically working from home, making sure that their cyber use is done the right way, and also just communication, making sure that all those pieces are done the right way and updated is very important. Because we see, and during these times of uncertainty in the market, and also you're seeing unemployment rates going up, you're going to see a lot more claims that are going to be popping up. We're going to see an uptick, we believe, in work comp claims, primarily because people are going to be taking on more responsibility, possibly, and doing other people's jobs that they are not properly trained for, and they're going to see a potential for injuries and work comp claims that are going to come because of that. So we need to make sure, again, going back to the handbook, making sure people understand the proper training process to get that through. The second one is Employer Practices Liability Insurance, or EPLI. This one actually, we've already seen a very large uptick into this area. This responds to claims alleging discrimination, retaliation, and other employment-related wrongful acts, dealing primarily with COVID, but it also covers even third party. Those are people that possibly come into the business, or a customer or a service provider coming into the business. That'll also cover those areas. Examples of that are the Family Medical Leave Act. If someone needs to be gone because of COVID-19, making sure that they're covered the right way is important. Also, if it's a hostile work environment. So now people are working remotely and your boss says, no, you need to come in, or you say, I can't do it because of this, this, and this. Those are all conversations that need to make sure, from the HR side, you can make sure that you're getting all of those taken care of the right way. And then really interesting conversation is folks getting on using their own home internet and their own home cell phone to do work. That's a business expense, and that's also can be covered underneath EPLI. So you need to make sure those things are covered, and that's why, again, going back to your handbook, making sure those pieces are put in place on that piece as well. And then one thing I did not put on there, but it is happening a lot more, is wage and hour issues. So with the remote workforce, the typical 40-hour work week that people say, hey, I'm going to work for my 40 hours, it's hard to determine that because now people are dealing with becoming a teacher at home and also doing their job and doing all these other pieces, and making sure that they're actually getting when does work end is a big question for folks. And then another piece of that is within wage and hour is when people are going back to work, and all of a sudden people say, I don't need to hire as many people as I did before, and all of a sudden you're not hiring a certain protected class of folks. That could become a wage and hour claim, which is an important piece. And then finally, we're looking into all of these then flow up into the directors and officers, or D&O coverage for conversation. So we're seeing named owners of companies and officers of companies being thrown into these claims and lawsuits that are coming down the pipeline. One piece that I think is very interesting that is on here is called the COVID calculator. And I'm more than happy to share what the COVID calculator is. When I get, it's a little bit, it takes the benefits for what you currently have, and then basically through COVID, it figures out how that's going to factor into your total spend, either increasing it or decreasing it. And now it's interesting that so within Marsh & McLennan, a lot of our competitors, such as are out there, and they're charging current clients and also former clients a fee to do this. And at Marsh & McLennan, we are doing this for both the self-insured and fully insured clients that are out there. So if you'd like for us to do a review and see how your benefit spend might look dealing with COVID, please reach out. We're happy to do that. And then lastly, go to the next slide. The last piece is just like Susan and just like Tim, we have a very large database of COVID-related resources that's updated every 3 to 4 hours every day. It has old webinars, future webinars. It has policies, procedures, possible HR handbook additions that you want to look at. And you can also sign up for updates in real time. That'll go to your inbox so you can have that information. And I'd be more than happy to help you all out. And I'm just very thankful. And I have a very short presentation, so we'll go to the next slide. And then I just want to say thank you. Here's my information. If you have any questions at all, please feel free to reach out to me. My email and my phone number is right on there. So I thank you all very much. And I'll give it back to Tim.
Very good. So thank you for that. And we do have an update from Tim Fogarty. So Tim, I'm going to go ahead and let you make that update now. Oh, sorry. Let me unmute you first, Tim. Sorry about that.
Okay, I'm unmuted. So, with this program, I think you have to be always looking at your computer to see what the updates are. So while this presentation was going on, there has been an update in terms of the safe harbor and the eligibility rules. And so we will post this update on our website, but it's pretty meaningful what the conclusion is here. So I'm just basically going to read this, off of it. The question was, how will the SBA review borrowers' required certification standing concerning the necessity of the request? And the answer, when submitting the PP application, all borrowers must certify in good faith that current economic uncertainty makes this loan request necessary to support ongoing operations of the applicant. SBA, in consultation with the Department of Treasury, has determined that the following safe harbor will apply to SBA's review of PPP loans with respect to this issue. Any borrower that, together with its affiliates, receive PPP loans with the original balance less than $2 million will deem to have been made the required certification concerning the necessity of loans in request in good faith. The SBA has determined that this safe harbor is appropriate because borrowers with below this threshold are generally less likely to have access to adequate sources of liquidity in the current economic environment than borrowers that obtain larger loans. This safe harbor will also promote economic certainty with PPP borrowers with more limited resources as they endeavor to retain and rehire employees. In addition, given the volume of PPP loans, this approach will enable the SBA to conserve its finite audit resources and focus on its review of larger loans where the compliance effort may yield higher returns. Importantly, borrowers with loans greater than $2 million that do not satisfy this safe harbor may still have adequate basis for making the required good certification based on their individual circumstances in light of language of the certification and the SBA guidance. The SBA previously stated that all PPP loans in excess of $2 million and other PPP loans as appropriate will be subject to review for compliance with program requirements set forth in the PPP internal interim final rules and the borrower application form. If the SBA determines in the course of this review that the borrower lacked adequate basis for the required certification concerning the necessity of the loan request, the SBA will seek repayment of the outstanding PPP loan and will inform the lender that the borrower is not eligible for loan forgiveness. If the borrower repays the loan after receiving notification from the SBA will not pursue administrative enforcement or referrals to other agencies based on its determination with respect to the certification concerning the loan request. The SBA's determination concerning the certification regarding the necessity of loan requests will not affect the SBA guarantee for the financial institution. So I think that really does add a lot of clarification in terms of the safe harbor. So I wanted to give that update. Just hot off the press, I've gotten like 3 or 4 emails from different people alerting me to this update during this presentation. So Mike, I'll hand that back to you. But I think that's really good news for all involved and a lot of clarity in terms of that provision.
All right, very good. Thank you, Tim. So we do have time for just a few questions here, but let me just reiterate that we are unable to offer specific advice. So we did get a bunch of questions. Most of you got direct replies. We will take questions that we aren't able to address today and create an FAQ where appropriate. But for a majority of these, we are going to refer you back to your banker or relationship manager or other tax professional for that advice, for legal advice as well. So with that said, let me jump back and take a couple of questions. Tim, these are for you that related to some of the forgiveness, just a little bit of clarification there. Let me just find that question again in my list. One of them said, when you say 25% can be used for interest on any debt, do you mean to include credit card interest? And let me unmute you, Tim, to answer that.
Yes. I mean, it was clear that any interest on an obligation that was, the credit card debt may be a little bit more limiting because the debt is, can be, you might have had credit card debt that you were paying interest before the covered period, but credit card debt on the charges on that credit card that occurred during the covered period may not be. So I haven't really looked through that. I haven't been asked that question before, so I guess I'll pause on that. And I think it's unclear or unknown at this point in terms of when the charge occurred on that charge card and when the interest started accruing for it.
All right, fair enough. Another question for you, Tim, here on the same general topic. Are ER taxes considered payroll costs? I have been seeing conflicting information on ER taxes.
I'll pass that one to Susan, if you don't mind, Susan.
No, I don't. Sorry, Tim. No, so ER, I'm sorry, would you mind reading the question again real quick? So, and is a question for the employee retention credit?
I believe that is correct.
Do
Are
the
ER taxes considered payroll costs?
Let me take that one offline with whoever is asking, because there has been some conflicting advice, and I'd like to talk a little bit more about, kind of what they're looking at.
Okay, fair enough. And again, if you're not hearing a question that you would ask directly answered here, know that we are going to log these and try to get some answers back to you as soon as we can. So again, just trying to be careful on picking and choosing which questions we are able to ask here. Let me just pause a moment and see if we have one that I can read here. Okay, and yeah, so let me do this. I encourage you to submit your questions through the question tool in the webinar here, and we will pull those together, get answers to you where appropriate, or refer you back to your legal or tax expert where needed as well. But with that said, I am going to leave the webinar open until the top of the hour in order for you to submit those questions to us. We'll log those. But I think at this time, we are just going to go ahead and wrap up. I do want to give you just a few reminders here. This was the first in a series of COVID-related webinars that we're producing. We are working on topics that include improving your sales and tax planning, valuations, fraud prevention, and more along those lines. Keep a lookout for emails from First Bank. And as always, check our COVID website on firstbanks.com for updates there. And again, I'm going to leave this open for you to submit some questions, but I'd like to thank you all for joining us today. And a special thank you to Tim, Susan, and Jake for their time and their expertise. I'm asking you to just take a few moments to complete a brief survey to help us improve our service to you. So with that said, have a great day, everyone. We'll catch you next time.